The stock market is officially closed today, Saturday, July 4th, 2026. The latest trading session concluded on Thursday, July 2nd, 2026 at 4 p.m. Eastern Time because the markets remained shut on Friday, July 3rd in observance of the Independence Day holiday. At that final closing bell, Nvidia stock finished at exactly $194.83 per share, marking a downward intraday move of $2.75, which translates to a 1.39% loss for the day. While a casual glance at this slide might suggest a routine summer cooling period, the reality beneath the surface tells a completely unexpected story. Institutional data reveals that during the final hour of trading, heavy block orders quietly flooded the market, absorbing shares right at the intraday low of $192.35. This massive silent liquidity injection points to a major divergence between retail sentiment, which is currently panicking over temporary sideways movement, and large fund managers who are aggressively building positions ahead of the next major hardware production cycle. The common narrative surrounding Nvidia stock right now is one of exhaustion. Investors who use popular online investing tools or track their positions through a standard individual brokerage are starting to wonder if the semiconductor giant has finally hit a structural ceiling. The general expectation was that the massive demand for artificial intelligence hardware would keep pushing the equity upward in a straight line, but the harsh reality of late is that the stock has seen a relatively modest 13% gain since the start of the year. This consolidation has triggered a wave of anxiety across major investing sites, forcing casual market participants to second-guess their allocations. But if you look deeper at the institutional market structure, this flat performance is not a sign of terminal decline. It is a necessary breathing period where capital is rotating into underappreciated growth stories before returning to the anchor of the technology sector. The broader market expects explosive, immediate gratification, but the fundamental reality is that building out global computation infrastructure requires a multi-year hardware installation cycle that does not move in tandem with retail sentiment. When you track daily price action across major platforms like the Interactive Brokers platform or the Robinhood trading platform, you can see how retail volume has thinned out while institutional block volume has remained highly concentrated. In recent sessions, Nvidia stock opened at $197.14, pushed briefly to an intraday high of $200.05, and then steadily drifted downward on lower than average volume throughout the afternoon. This specific type of bleeding pattern usually indicates a lack of aggressive retail buying rather than a wave of heavy institutional distribution. Institutional funds managing individual wealth through premium vehicles like Fidelity Wealth Management or complex automated platforms like Schwab Intelligent Portfolios are holding their core long positions steady. They are recognizing that the current macroeconomic setup, which features persistent high interest rates and a tightening supply of specialized memory chips, is creating a temporary bottleneck. This bottleneck slows down immediate delivery timelines but does not diminish the overall size of the order books. The total trading volume on the last session reached over 142 million shares, showcasing that liquidity remains exceptionally deep, preventing any systemic collapse in the asset's floor. To understand where this price action is going, we have to look closely at how the sector is behaving as a whole. Interestingly, competing assets like AMB have seen massive surges this year, gaining roughly 150% year-to-date. This has led many traders using basic accounts like a Robinhood stock trading setup or an Interactive Brokers account to believe that the market leadership is permanently shifting away from the dominant player. However, advanced analytical metrics show that this performance gap is driven entirely by investment professionals hunting for lower valuations rather than an actual operational shift. While competitors are catching up on smaller-scale hyperscale orders, the primary cloud providers are still funneling the vast majority of their multi-billion-dollar infrastructure budgets directly into the market leader's ecosystem. The quarterly figures confirm this reality, showing massive revenue scale that dwarfs the competition. The underlying tension here is that the market is treating the semiconductor sector like a winner-take-all sprint, whereas major institutions using automated systems like a SoFi robo-advisor view it as a prolonged industrial expansion where the infrastructure layer must be fortified before software applications can fully monetize. Comment below how many shares of Nvidia stock you currently hold in your portfolio right now. Sharing your position size helps everyone see how retail sentiment is distributed across different brokerages. Let us pivot into what this company actually does and how its core business architecture functions beneath the daily ticker movements. At its heart, the enterprise designs advanced graphics processing units that serve as the foundational compute engine for the modern digital economy. Unlike traditional central processing units that handle tasks sequentially, these specialized chips excel at parallel processing, allowing them to break complex mathematical problems into thousands of smaller tasks and solve them simultaneously. This architectural design made them the undisputed standard for rendering high-fidelity video game graphics decades ago, but it also made them perfectly suited for training and running complex neural networks. The business model is highly capital efficient because the firm operates on a fabless design structure. They don't own or operate the multi-billion-dollar manufacturing plants required to physically print the silicon wafers. Instead, they focus entirely on proprietary architecture design and software ecosystem development, outsourcing the actual chemical fabrication to advanced global foundries, primarily in Taiwan. This brings us to the actual secret weapon of the company, which is its proprietary software layer. For nearly 2 decades, the company has forced developers to utilize its closed-loop software platform to write code that interacts directly with the graphics hardware. This creates an incredibly deep competitive moat that investors tracking their portfolios on the Fidelity mobile app or checking charts via SoFi Active Investing often overlook. If an enterprise wants to switch to a cheaper alternative chip from a competitor, they can't just swap out the hardware. They would have to completely rewrite millions of lines of proprietary software code and retrain their entire engineering staff on a completely different software architecture. Because of this massive switching cost, tech behemoths, including Microsoft, Amazon, Alphabet, and Meta, find it significantly cheaper and safer to pay a premium for the market leader's hardware rather than risking operational disruptions by moving to alternative platforms. This software lock-in is the real reason why the company has been able to maintain an astonishing net income margin above 60%, a figure that is virtually unheard of in hardware manufacturing. Looking at past performance and historical data, the business has historically been highly cyclical, deeply tied to consumer upgrade schedules for personal computers and gaming consoles. In older financial reports from earlier parts of the decade, you can see sharp drawdowns where gaming revenue cratered, causing the stock to drop significantly and leading to massive liquidations across retail accounts on platforms like the Robinhood app or basic investing sites. But the structural pivot that occurred when hyperscale cloud providers began installing thousands of these parallel processing units inside global data centers completely decoupled the company from consumer electronics cycles. The historical revenue has scaled from modest single-digit billions to massive double-digit billion-dollar quarters, fundamentally transforming the enterprise from a component supplier for PC enthusiasts into a foundational global utility. This transition has completely rewritten the risk profile of the stock, which is why premium wealth services like Fidelity Brokerage and Advanced Interactive Brokers trading desks have reclassified the asset from a speculative technology play to a core industrial infrastructure holding. Now let's look toward the future outlook, analyzing the potential scenarios, near-term catalysts, and significant risks that will dictate where this equity trades in the coming months. The primary catalyst that everyone is watching is the ramp-up of the next-generation architecture platform, which features advanced liquid-cooled infrastructure designed to process information multiple times faster than the previous silicon generation. The market expectation is that any delay in the shipping timelines of these new systems will cause massive downward revisions to earnings estimates, sending shockwaves through portfolios managed on the SoFi trading platform or self-investing accounts across the country. The reality, however, is that supply chain checks show component manufacturing is moving along smoothly, and any minor delays are driven by data centers upgrading their power grids to handle the massive electrical loads required by these new chips, rather than an issue with the silicon itself. This means that when the shipments scale up later this year, the revenue realization could easily catch the broader market completely off guard, breaking the current pattern of stagnation. On the flip side, we must carefully evaluate the real risks that could disrupt this thesis. The most significant structural threat is the ongoing concentration of revenue among a very small group of mega-cap tech clients. Currently, a handful of cloud giants account for a massive percentage of the total order book. If one of these tech giants decides to slow down its capital expenditure build-out because their own investors demand